In this video, I'm going to talk about the three ways that most people build an investment portfolio. Number one, systematic purchases, okay? Also referred as formula investing, right? As it used to be called in the past. And then number two is valuation. And then number three is market timing. Now, please note that the first two, that is systematic purchases and market and valuation, have made a lot of people very rich. While the third, which is market timing, is a form of speculation which cannot be repeated indefinitely, as it often leads to wipe out, right? In other words, you're gonna wipe your entire portfolio out, right? Sooner or later. And normally it's sooner, right? So the thing to remember is that when it comes to systematic purchases, this is where the investor buys or sells methodically through regularly scheduled transactions, regardless of market or economic conditions. Meaning that, and I'll give you an example that which will make things very clear. Is that, let's say I say that I'm going to invest $200 at the end of each month, right? After every 30 days, I'm going to invest $200, let's say in an index fund, right? That is an example of systematic purchases, right? It's a systemized approach or a systemized method according to which you are investing, right? So it doesn't matter if the markets are doing well. In other words, the markets are booming and valuations are very high, or if the market has crashed or the markets are pessimistic, right? And it's a gloom and doom environment, and the valuations are very low, right? It doesn't matter, right? The investor who's following the systematic purchase approach is going to keep putting in $200 every month, right? It could be anything, right? It could be like you investing $1,000 every 3 months, 2 months, whatever, right? Whatever the amount could vary based on your circumstances, and the time period could be whatever you decide it to be. But you must stick with it, right? So that's what systematic purchases is. Then we have valuation, okay? Now valuation is basically where the investor buys or sells based upon the relationship between market price and after-tax inflation-adjusted discount-free cash flows of the asset. So let me just make it very simple. It's basically valuation is basically where we are estimating how much cash flow, right, will the company generate, whatever company you are planning to buy or invest in. You need to be able to estimate how much cash flow on an annual basis will that company generate over your holding period, right? Over your holding period. So for example, let's say I'm going to buy the company for 10 years. Then I need to be able to estimate how much cash flow that company is going to generate over that 10-year time period. And then we also need to estimate what is the price going to be after at the end of the holding period, right? Because remember, if we buy the stock for 10 years and we plan to sell it after 10 years, then after 10 years, once the 10 years have passed, then we are going to the stock will still be on the owner of the stock, and let's say we're going to sell the stock. So we also need to be able to estimate the value of the stock or the market price of the stock after 10 years, right? And so when we put all of this together, so when we say, okay, so next 10 years, over each of the next 10 years, this is the amount of cash flow the company is going to generate. And then after 10 years, this is going to be the price of the stock for which I will sell it. And that's also going to result in a cash inflows for you. And so that's basically how you value the stock, okay? Basically, in very simple terms, you're trying to assess how much cash that company is going to generate for you, and you're going to apply a discount to those future cash flows, right? Because remember, if I pay $100 today and after 1 year I get $100, then I have not made any money. In fact, I might have lost money because of inflation, right? So what I'm going to do is if I'm investing, what I'm going to do is I'll say, okay, let's say I'm going to receive, let's say $120 after 1 year. So today I'll just pay $100, right? So that way, if I pay $100 today and I get $120 after 1 year, $120 after 1 year, then I've made a 20% return. So that's the concept behind discounting, right? You need to discount those future cash flows. So that's basically what valuation is, right? Now, the third way that most people build their investment portfolio is market timing, okay? Market timing is when an individual buys or sells an asset, specifically a stock, let's say, based upon whether he or she thinks the security will increase or decrease in price for any reason other than its valuation, right? On the just a minute ago, I was explaining what valuation is, and please understand that if you are buying and selling a stock, let's say, or any cash generating asset for that matter, for any reason other than its valuation, right? For example, let's say the price of the asset is 200, while the value is 100, right? If I've calculated the value, and I'm comparing it against the price, the current market price, then that is the valuation approach. But if and based on the valuation approach, I am also going to the people who are following the valuation approach are also expecting the price to go up or down, right? But the basis of their decision, of their estimate of the price going up or down, is based on the comparison between the market price and the actual intrinsic value of the asset. Now, in market timing, you are trying to buy or sell the asset, right? Because you have an expectation that the price is going to go up or down, right? It could be either. But the basis is anything other than valuation, right? If you're not valuing the asset and you have some other reason, someone gave you a tip and said, a stock tip and said, this stock is going to go up, and you have no idea about the underlying fundamentals, and you have no idea about the underlying value of the asset or the stock, then you are following market timing, right? And remember, this is a form of speculation. Okay, this is not investing. Now, that's what market timing is about, right? So we just discussed the three methods, right? Systematic purchases, where the investor is investing a specific amount of money in let's say in an index fund, right? Over a specific time period, right? Over a specific interval, right? So for example, I'm putting in, like I gave the example that I'm putting in $200 after every month, right? That's an example of systematic purchases. This has made a lot of people very rich. Now remember, the advantage of this approach is that you can be quite hands off, right? You don't need to read annual reports. You don't need to understand the business. You don't need to understand the industry. You don't need to, it's a hands-off approach, right? Because remember, you're not concerned with any of that thing, right? You have some savings, or you're saving every month or after a specific time period, and you just want to allocate that money without the hassle of having to understand corporate finance, without having to study in businesses and how to evaluate and value business. You don't want to do any of that. So for people like following this method, that's their approach, right? They don't want to be bothered, and they just want to earn a decent return. And history has shown that these people have made a lot of money over a relatively long period of time. Remember that. It's a relatively long period of time. Now, when it comes to valuation, this is where the majority of the extremely wealthy, they operate, right? So, example would be Warren Buffett, Charlie Munger, Peter Lynch, all these guys, Mohnish Pabrai. These guys follow the valuation approach, right? And then, of course, there is market timing, which I've just explained, is that you are basing your investment decisions on anything, or you're expecting the stock to go up or down in price based on anything other than the valuation, right? And this is a form of speculation. Over the next 2 to 3 videos, I'm going to talk about each of these methods in more detail, specifically who should follow which approach, right? And of course, I'm going to talk about market timing and talk about why you need to just avoid this approach, right? Because this is a short way of destroying wealth. If you're interested in the video and other such content from my end, then please follow and subscribe. And I will see you guys in the next one. Take care. Bye for now.